Question 1. A registered representative involved in an M&A transaction is typically responsible for preparing and delivering which of the following to potential buyers? A. Prospectus. B. Definitive agreement. C. Confidential information memorandum, CIM. D. Comfort letter. Answer: C. Confidential information memorandum, CIM. In an M&A transaction, the registered representative often helps the seller prepare a confidential information memorandum, CIM, which is a detailed marketing document used to present the target company to prospective buyers. Unlike a prospectus, which is used for public offerings, the CIM is specific to private sales and provides comprehensive information about the company's operations, financials, and market position. This document is typically distributed after interested parties have signed a non-disclosure agreement, NDA, to ensure confidentiality. Always remember that the CIM is the primary marketing document for a private M&A sale. Question 2. Under the Securities Act of 1933, what is the primary purpose of requiring issuers to file a registration statement for new securities offerings? A. To guarantee the profitability of the securities for investors. B. To ensure the fair pricing of the securities in the market. C. To provide full and fair disclosure of all material information to potential investors. D. To prevent any losses from occurring for investors in the secondary market. Answer: C. To provide full and fair disclosure of all material information to potential investors. The Securities Act of 1933 is often referred to as the Truth in Securities law because its core purpose is to ensure that investors receive essential information about securities offered for public sale. By requiring issuers to file a registration statement, such as an S-1, and provide a prospectus, the Act aims to enable investors to make informed investment decisions, not to guarantee investment performance or pricing. Think of the registration statement as a comprehensive playbook for the investment, allowing potential buyers to understand all the risks and rewards. Question 3. Which of the following best describes the primary characteristic of a firm commitment underwriting? A. The underwriter acts solely as an agent, selling securities on behalf of the issuer without taking on risk. B. The underwriter agrees to purchase all of the securities from the issuer and resell them to the public, assuming inventory risk. C. The issuer retains the right to cancel the offering if the desired price is not met. D. The underwriter attempts to sell as many securities as possible but is not responsible for unsold shares. Answer: B. The underwriter agrees to purchase all of the securities from the issuer and resell them to the public, assuming inventory risk. In a firm commitment underwriting, the investment bank, acting as the underwriter, commits to buying the entire offering of securities from the issuer. This means the underwriter takes on the financial risk of any unsold shares, making them primarily responsible for the success of the offering. This type of underwriting provides the greatest certainty of proceeds for the issuer because the underwriter guarantees the purchase. Contrast this with best efforts underwriting, where the underwriter only acts as an agent and does not guarantee the sale of all shares. Question 4. In a Chapter 11 bankruptcy proceeding, what is the primary objective? A. To liquidate all of the debtor's assets immediately and distribute proceeds to creditors. B. To reorganize the debtor's business and finances, allowing it to continue operating. C. To provide a temporary stay on creditor collection efforts without any plan for reorganization. D. To allow secured creditors to seize assets without any court oversight. Answer: B. To reorganize the debtor's business and finances, allowing it to continue operating. Chapter 11 of the U.S. Bankruptcy Code is designed for business reorganization, allowing a financially distressed company to continue its operations while it develops a plan to repay its debts. The goal is to rehabilitate the business, preserve jobs, and maximize value for all stakeholders, rather than simply shutting down and selling off assets. This contrasts with Chapter 7 bankruptcy, which focuses on liquidation. Remember, Chapter 11 aims for a fresh start, not an immediate end. Question 5. When calculating enterprise value, EV, which of the following is typically added to equity value? A. Cash and cash equivalents. B. Net debt, gross debt minus cash and cash equivalents. C. Accounts receivable. D. Depreciation and amortization. Answer: B. Net debt, gross debt minus cash and cash equivalents. Enterprise value, EV, represents the total value of a company, including both its equity and debt, less any cash. It reflects the total cost to acquire a company, including taking on its debt and benefiting from its cash. Therefore, when moving from equity value, market capitalization, to enterprise value, you would add the company's net debt, which is gross debt minus cash and cash equivalents, and also add preferred stock and non-controlling interests. Think of enterprise value as the cost of acquiring the entire business, not just the common stock. Question 6. A lock-up agreement in the context of an initial public offering, IPO, typically restricts which parties from selling shares for a specified period after the IPO? A. Only the underwriters of the offering. B. Only the institutional investors who purchased shares in the IPO. C. Company insiders, including executives, directors, and significant pre-IPO shareholders. D. All public investors who purchase shares in the secondary market. Answer: C. Company insiders, including executives, directors, and significant pre-IPO shareholders. A lock-up agreement is a contractual provision preventing insiders, such as company executives, directors, and venture capitalists, from selling their shares for a specific period, commonly 90 to 180 days, after an initial public offering, IPO. This restriction is designed to prevent a flood of shares hitting the market shortly after the IPO, which could depress the stock price and harm investor confidence. It signals to new investors that insiders are committed to the company's long-term success. Question 7. What is the primary purpose of a fairness opinion in an M&A transaction? A. To legally compel the target company's board to accept an offer. B. To provide an independent assessment to the target board regarding the financial fairness of the proposed transaction. C. To determine the specific price at which the target company's shares will trade post-merger. D. To guarantee that the target company's shareholders will receive a profit from the transaction. Answer: B. To provide an independent assessment to the target board regarding the financial fairness of the proposed transaction. A fairness opinion is an independent assessment prepared by an investment bank or another financial advisor for a company's board of directors, typically the target company in an M&A deal. Its purpose is to provide an objective view on whether the financial terms of a proposed transaction are fair to the company's shareholders from a financial point of view. It is not a recommendation to accept or reject the offer, nor does it guarantee specific financial outcomes, but rather assists the board in fulfilling its fiduciary duties. Question 8. Under SEC Rule 14 times 10 to the power of -1, how long must a tender offer remain open to shareholders? A. A minimum of 5 calendar days. B. A minimum of 10 business days. C. A minimum of 20 business days. D. A minimum of 30 calendar days. Answer: C. A minimum of 20 business days. SEC Rule 14 times 10 to the power of -1, which governs tender offers, mandates that a tender offer must remain open for a minimum of 20 business days. This duration provides ample time for shareholders to consider the offer, assess its terms, and make an informed decision about tendering their shares. The rule also requires that any change to the percentage of securities sought or the consideration offered necessitates the offer to remain open for at least 10 business days from the date of the change. This helps ensure fair treatment and sufficient time for investors. Question 9. In a discounted cash flow, DCF, model, which of the following is typically a key input for projecting free cash flows? A. Historical stock prices of comparable companies. B. Forecasted revenues and operating expenses. C. Current market capitalization of the company. D. book value of the company's assets. Answer, B. Forecasted revenues and operating expenses. The discounted cash flow, DCF, model is a valuation method that estimates the value of an investment based on its future cash flows. Key inputs for projecting these free cash flows include detailed forecasts of the company's revenues, operating expenses, capital expenditures, and changes in working capital over a projection period. These projections are crucial because they directly determine the cash that the company is expected to generate, which is then discounted back to a present value to arrive at the valuation. Remember that DCF is forward-looking and heavily reliant on sound financial projections. Question 10. A greenshoe option, or over-allotment option, in an IPO allows the underwriter to do which of the following? A. Purchase additional shares from the issuer to cover oversubscriptions, up to 15% of the offering size. B. Sell shares back to the issuer if the offering is undersubscribed, reducing the underwriter's risk. C. Extend the lockup period for company insiders by an additional 90 days. D. Increase the initial public offering price if demand is unexpectedly high. Answer, A. Purchase additional shares from the issuer to cover oversubscriptions, up to 15% of the offering size. A greenshoe option is a standard provision in an underwriting agreement that grants the underwriters the right to sell more shares than initially planned in an IPO if there is exceptionally high demand. This option allows them to sell up to an additional 15% of the original offering size, helping to stabilize the stock price after the IPO by providing shares to cover oversubscriptions without having to go into the open market. This mechanism helps manage price volatility and facilitate a smooth market debut for the new stock. Question 11. What is the primary role of the Trust Indenture Act of 1939? A. To regulate the issuance of equity securities. B. To require the appointment of a trustee for corporate bond issues, acting on behalf of bondholders. C. To prevent insider trading in corporate securities. D. To establish rules for the registration of investment companies. Answer, B. To require the appointment of a trustee for corporate bond issues, acting on behalf of bondholders. The Trust Indenture Act of 1939 was enacted to protect bondholders by requiring that most corporate debt issues of $50 million or more be issued under a trust indenture. This indenture must be approved by the SEC and appoint a qualified independent trustee, typically a bank or trust company, to represent the bondholders' interests in the event of default by the issuer. This ensures that bondholders have an advocate to enforce the terms of the bond agreement. Question 12. Which of the following best describes the purpose of a definitive agreement in an M&A transaction? A. It is a preliminary, non-binding document outlining the initial terms of a deal. B. It is the legally binding contract detailing the terms and conditions of the merger or acquisition. C. It is a marketing document used to solicit interest from potential buyers. D. It is a regulatory filing submitted to the SEC before any deal negotiations begin. Answer, B. It is the legally binding contract detailing the terms and conditions of the merger or acquisition. The definitive agreement, also known as the merger agreement or purchase agreement, is the final, legally binding contract that formalizes all the terms and conditions of an M&A transaction. This comprehensive document outlines the purchase price, payment method, representations and warranties, closing conditions, covenants, and termination provisions. It is typically signed after extensive due diligence and negotiation, marking the formal commitment of both parties to the transaction. Until this document is signed, much of the deal remains subject to change. Question 13. Which type of merger structure results in the target company becoming a subsidiary of the acquiring company, maintaining its own legal existence? A. Forward merger. B. Reverse triangular merger. C. Consolidation. D. Statutory merger. Answer, B. Reverse triangular merger. In a reverse triangular merger, the acquiring company forms a subsidiary, and this newly formed subsidiary then merges with the target company, with the target company surviving the merger. This structure is often used when the target company holds important contracts or licenses that would be difficult to transfer if the target ceased to exist. In essence, the target company becomes a subsidiary of the acquirer, preserving its legal entity. Question 14. An investment banking firm typically charges a success fee in an M&A advisory engagement. This fee is generally contingent upon what event? A. Signing of the engagement letter. B. Completion of the due diligence process. C. The successful closing of the transaction. D. The preparation of a valuation report. Answer: C. The successful closing of the transaction. A success fee is a common component of an investment banking firm's compensation for advisory services, particularly in M&A transactions. This fee is contingent upon the successful completion, or closing, of the deal. Unlike a retainer fee, which is paid up front regardless of the outcome, the success fee aligns the interests of the advisor with those of the client, as the advisor only gets paid a substantial amount if the transaction goes through. This structure incentivizes the investment bank to work diligently towards a successful outcome. Question 15. The Securities Exchange Act of 1934 primarily regulates which of the following? A. The initial public offering of new securities. B. The issuance of municipal bonds. C. The trading of securities in the secondary market and market participants. D. The formation and operation of mutual funds. Answer: C. The trading of securities in the secondary market and market participants. The Securities Exchange Act of 1934 is the foundational law governing the secondary market for securities, meaning the trading of existing securities, and the operation of the stock exchanges, brokers, and dealers. It established the Securities and Exchange Commission, SEC, and introduced regulations aimed at preventing manipulation, ensuring fair and orderly markets, and requiring ongoing disclosures from public companies. While the 1933 Act covers new issues, the 1934 Act focuses on the continuous trading environment. Question 16. Under Regulation D of the Securities Act of 1933, an accredited investor is typically defined, in part, by meeting certain income or net worth thresholds. Which of the following is an example of an accredited investor? A. An individual with a net worth of $500,000, excluding primary residence. B. An individual who earned $150,000 in each of the past 2 years and expects to earn the same in the current year. C. An individual who earned $200,000 in each of the past 2 years and expects to earn the same in the current year, or joint income with a spouse of $300,000. D. A corporation with assets of $3 million. Answer: C. An individual who earned $200,000 in each of the past 2 years and expects to earn the same in the current year, or joint income with a spouse of $300,000. Regulation D provides exemptions from SEC registration for certain private offerings, primarily for accredited investors. For individuals, the definition of an accredited investor generally includes someone with an income of $200,000 or more in each of the 2 most recent years, or $300,000 with a spouse, and a reasonable expectation of reaching the same income level in the current year, or a net worth of over $1 million, excluding the value of their primary residence. This standard is designed to ensure that investors in private placements have the financial sophistication and capacity to bear the risks associated with less regulated offerings. Question 17. Which of the following is typically a key component of an investment banking pitch book? A. The definitive merger agreement. B. A detailed fairness opinion. C. Market overview, valuation analysis, and potential transaction structures. D. The final prospectus for a public offering. Answer: C. Market overview, valuation analysis, and potential transaction structures. An investment banking pitch book is a marketing presentation used to win new business or advise clients on potential transactions. It typically includes an overview of the market, a detailed valuation analysis of the client's company or target companies, potential transaction structures, example M&A, financing options, and a summary of the investment bank's qualifications and capabilities. This document is a critical tool for initial client engagement and outlining strategic options, serving as a dynamic proposal rather than a static legal document. Question 18. What is the primary purpose of conducting due diligence in an M&A transaction? A. To finalize the definitive agreement without further negotiation. B. To market the target company to potential buyers. C. To verify the accuracy of information provided by the target company and identify potential risks or liabilities. D. To obtain regulatory approval from the SEC. Answer. C. To verify the accuracy of information provided by the target company and identify potential risks or liabilities. Due diligence is a critical phase in an M&A transaction where the buyer conducts a thorough investigation and review of the target company's business, finances, legal affairs, and operations. The primary purpose is to verify the accuracy of information provided by the seller, identify any undisclosed liabilities, risks, or opportunities, and ensure that the buyer has a complete understanding of what they are acquiring. This process is essential for informed decision-making and for structuring the deal appropriately. Question 19. A registered representative who becomes aware of suspicious financial activity that may indicate money laundering is required to file which of the following? A. Currency Transaction Report, CTR. B. Suspicious Activity Report, SAR. C. Anti-Money Laundering, AML, Compliance Report. D. Financial Intelligence Unit, FIU, Disclosure. Answer. B. Suspicious Activity Report, SAR. Financial institutions, including broker-dealers, are mandated by the Bank Secrecy Act to report suspicious financial activities that might indicate money laundering, terrorist financing, or other illegal activities. A Suspicious Activity Report, SAR, must be filed with FinCEN, Financial Crimes Enforcement Network, within 30 days of the firm becoming aware of the suspicious activity. Unlike a Currency Transaction Report, CTR, which is filed for cash transactions exceeding $10,000, a SAR is based on the suspicion of illegal activity, regardless of the amount. Question 20. In an IPO, which of the following best describes the role of the syndicate members? A. They act as independent auditors, verifying the issuer's financial statements. B. They purchase the entire offering from the lead underwriter and hold the securities for long-term investment. C. They assist the lead underwriter in selling the securities to the public and share in the underwriting risk. D. They provide legal advice to the issuer regarding the registration process. Answer. C. They assist the lead underwriter in selling the securities to the public and share in the underwriting risk. In a public offering, the syndicate consists of a group of investment banks that collectively work with the lead underwriter to distribute the new securities to investors. Syndicate members commit to selling a portion of the offering and share in the underwriting risk and fees. This collaborative approach helps ensure wide distribution of the shares and efficient execution of the offering, diversifying the sales effort beyond just the lead firm. Question 21. What is the primary restriction imposed by FINRA Rule 5130, restrictions on the purchase and sale of initial equity public offerings? A. It prohibits broker-dealers from participating in IPOs of foreign companies. B. It restricts broker-dealers and their associated persons from receiving compensation based on IPO allocation size. C. It prohibits broker-dealers and their associated persons from purchasing IPO shares for their own accounts or for the accounts of certain restricted persons. D. It limits the maximum number of shares an individual investor can purchase in an IPO. Answer. C. It prohibits broker-dealers and their associated persons from purchasing IPO shares for their own accounts or for the accounts of certain restricted persons. FINRA Rule 5130, often referred to as the New Issue Rule, is designed to ensure that IPO shares are offered to the public and to prevent industry insiders from profiting from their privileged access. It strictly prohibits broker-dealers and their associated persons, as well as immediate family members and certain other restricted persons, from purchasing shares in an IPO. This rule helps maintain fairness and public confidence in the IPO process. Question 22. When performing valuation analysis, what is the primary benefit of using precedent transactions as a methodology? A. They provide an accurate future projection of a company's cash flows. B. They reflect the current market trading multiples of publicly traded companies. C. They indicate what real buyers have recently paid for comparable companies, including control premiums. D. They offer a direct measure of a company's intrinsic value based on its assets. Answer: C. They indicate what real buyers have recently paid for comparable companies, including control premiums. Precedent transactions analysis is a valuation methodology that involves comparing the company being valued to similar companies that have recently been acquired. This approach is highly relevant because it reflects actual M&A market values, including any control premiums that buyers were willing to pay. Unlike public trading multiples, which reflect minority stakes, precedent transactions illustrate what an acquirer has paid for control of an entire company. This makes them a strong indicator of potential acquisition value. Question 23. Which SEC filing is typically used to report significant material events that are of importance to shareholders, such as a merger agreement, bankruptcy, or change in control? A. Form 10-K. B. Form 10-Q. C. Form 8-K. D. Form 13-F. Answer: C. Form 8-K. Form 8-K is known as the current report that public companies must file with the SEC to announce major material events that shareholders should know about promptly. These events can include everything from changes in executive management, entry into or termination of a material definitive agreement, like a merger agreement, bankruptcy, or a change in control of the company. Companies are typically required to file an 8-K within 4 business days of the event, ensuring timely disclosure of critical information. Question 24. What is the main purpose of an engagement letter in an investment banking advisory role? A. To formalize the investment bank's commitment to purchase all securities in an offering. B. To outline the scope of services, fees, and terms of the relationship between the client and the investment bank. C. To provide a preliminary valuation of the client's company. D. To serve as the final, legally binding agreement for an M&A transaction. Answer: B. To outline the scope of services, fees, and terms of the relationship between the client and the investment bank. An engagement letter is a formal, legally binding contract that establishes the relationship between an investment banking firm and its client for advisory services, such as M&A or financing. This letter clearly outlines the specific services the investment bank will provide, the fee structure, including retainers and success fees, reimbursement of expenses, indemnification provisions, and the term of the engagement. It sets the groundwork for the entire advisory relationship, ensuring both parties understand their roles and responsibilities. Question 25. An individual who trades securities based on material, non-public information obtained from an insider is engaging in what illegal activity? A. Market manipulation. B. Front-running. C. Insider trading. D. Touting. Answer: C. Insider trading. Insider trading refers to the illegal practice of buying or selling a security based on material, non-public information about that security. This information is considered material if it would significantly affect an investor's decision to buy, sell, or hold the security, and non-public if it has not been disseminated to the general public. Whether the individual is the insider themselves or a tippee who received the information from an insider, using such information for personal gain is a serious violation of securities laws, undermining the fairness and integrity of the markets.